Booyah! That's the sound of opportunity, folks. The sound of money being made, deals being struck, and fortunes being built. But what if I told you the rules of the game are changing? What if the biggest player on the field decided to switch strategies? Listen up, folks, because this is not just another news story. This is about how the global economy is about to be reshaped. This is about understanding the forces at play and positioning ourselves to navigate the changes ahead. We need to talk about China. It's impossible to ignore their influence, their sheer economic weight. For years, China has been a powerhouse, a driving force behind global growth. Their economic expansion has been nothing short of remarkable, transforming the world as we know it, investing everywhere from infrastructure projects in Africa to tech startups in Silicon Valley. No corner of the globe has been untouched by Chinese investment and shaping industries worldwide. They've become a dominant force in manufacturing, technology, and countless other sectors. This isn't pocket change. We're not talking about small investments here. It's colossal sums, mind-boggling amounts of capital flowing across borders, creating jobs and fueling innovation. Their investments have spurred growth and development in countless communities around the world. China's aggressive investment strategy, carefully planned and meticulously executed, made it a financial titan, a force to be reckoned with on the global stage. And the world got used to it. We became accustomed to their constant presence, their ever-expanding influence. Their money reached deep into Western economies, propping up industries and fueling growth. From Silicon Valley, where they invested heavily in cutting-edge technologies, to Midwest manufacturing, where they helped revitalize struggling industries. Beijing's strategy was deliberate, a long-term vision with clear objectives. Secure resources, ensuring a steady supply of raw materials to fuel their economic engine, access new tech, acquiring the knowledge and expertise needed to stay ahead of the curve, expand influence, projecting their power and shaping the global order. They became lenders, providing crucial financing to countries and businesses around the world, buyers, acquiring strategic assets and expanding their global footprint, and major players in international finance, wielding significant influence over global markets. The world watched, often with a mixture of fascination and apprehension, sometimes in awe of their economic prowess, sometimes with nerves about their growing power, but always knowing China's investments mattered. Their decisions had ripple effects across the globe. Their checkbook diplomacy defined the global economy, shaping trade agreements and influencing international relations. We all got comfortable with China writing the checks, didn't we? We factored it into our economic models, our investment strategies. So, when we talk about China, we're not just talking about a country. We're talking about a global economic force. We're talking about a financial juggernaut, an economic superpower with the ability to move markets and shape destinies. Whose choices can make or break fortunes. Their decisions send shockwaves through the global financial system. This role created dependencies and expectations. The world became reliant on Chinese investment and manufacturing. And now, in June 2025, a seemingly ordinary month, that pattern is shifting. The tectonic plates of the global economy are beginning to move. China, the big spender, the engine of global growth, is changing its tune. The music is different, the rhythm is off, and the world is scrambling to adjust. The band is starting to sound very different, and the implications are enormous. What does this shift mean for you, for your investments, for the future of the global economy? That's what we're here to explore. What's the big news? China is cutting back, big time. The money faucet is tightening, and it's not just a rumor, the numbers prove it. For 2 decades, Chinese investment was always up, until now. Wall Street and global markets expected the party to keep going, not for the music to stop. Why the change? China's economy faces headwinds, a shaky property market, demographic shifts, and a need to boost internal consumption. Beijing is focusing inward, fixing its own house before splurging abroad. Geopolitical tensions are also a factor. Relations with the West are frostier and scrutiny is up. More hurdles, more suspicion, less incentive to invest overseas. This is a strategic pivot, not a whim. China is recalculating risk and reward in a changed world. It's a calculated move. Why is Wall Street suddenly in a state of shock? Why are the titans of finance seemingly losing their composure? Because for years the street has been comfortably, almost addictively, hooked on Chinese money. It's been the lifeblood of many ventures, the silent partner in countless deals. Investment bankers, the dealmakers who thrive on global capital flows, fund managers, responsible for deploying billions, and CEOs, the visionaries steering corporate empires, all relied on that readily available capital to fuel ambitious growth strategies and artificially inflate company valuations. It was a symbiotic relationship, or so it seemed. Now, the candy jar, that seemingly bottomless source of funds, is abruptly being taken away. The tap is being turned off. And as the realization dawns, panic is setting in, spreading like wildfire through the financial district. This isn't just about losing a few lucrative deals or facing some short-term setbacks. It's a fundamental and unsettling reassessment of future growth prospects. The assumptions that underpinned years of bullish forecasts are now crumbling. U.S. corporations, especially tech giants, the darlings of Wall Street, and multinational corporations with sprawling global operations, are heavily exposed to China, not only as a crucial and expanding market for their goods and services, but also as a significant investor providing vital capital for expansion and innovation. A pullback in Chinese investment and consumer spending means fewer buyers for American products, less readily available funding for new ventures and existing projects, and a decidedly chillier business climate overall, making growth harder to achieve. The era of easy money, fueled by Chinese investment, is rapidly drying up, and that's profoundly scary for those who built their empires and strategies on the assumption of its continued availability. Wall Street had confidently assumed that Chinese capital was a permanent fixture of the global financial landscape, a given and unshakable foundation. Now that fundamental assumption is very much in question, casting a long shadow of doubt over future prospects. The sudden and unexpected cutback in Chinese investment has caught many key players completely off guard, leaving them scrambling to adjust. This unexpected shift is fueling widespread anxiety and deep uncertainty about the future direction of the markets. And when the big players, the institutional investors and corporate giants, get nervous and start to question their strategies, rash and often poorly considered decisions inevitably follow, exacerbating the volatility. The script has flipped dramatically, the old rules no longer apply, and Wall Street is now scrambling to rewrite the narrative and adapt to this new reality. The new lines are still being written, the future remains uncertain, and the only certainty is that volatility will likely continue. Let's get down to brass tacks. We need to understand the real-world implications of these economic shifts. It's not just about numbers on a screen, it's about how these changes affect your investments, your job, and even your home. Where is this cut hitting the hardest? Which sectors are most vulnerable, and which might even benefit from these changes? It's crucial to identify the pressure points to navigate the current economic climate effectively. U.S. stocks, particularly those with international exposure, are feeling the heat. Especially those reliant on Chinese investment or sales are facing significant headwinds. The once reliable flow of capital is slowing, creating uncertainty and impacting growth projections are feeling the chill. Investors are becoming more cautious, leading to increased volatility and downward pressure on stock prices. The Nasdaq, loaded with tech companies, is particularly vulnerable to these shifts. Its high concentration of growth stocks makes it susceptible to changes in investor sentiment and capital flows. Less Chinese money flowing into the market means tougher times for stock prices, especially for those tech companies that have benefited from significant Chinese investment. Silicon Valley thrived on Chinese capital, which fueled its rapid expansion and innovation, fueling innovation and sky-high valuations. This influx of capital allowed startups to take risks and pursue ambitious projects, driving technological advancements. Now, startups may struggle to raise cash, facing a more challenging fundraising environment. Venture capitalists are becoming more selective and valuations are being reassessed. IPOs could slow significantly as companies delay their public offerings due to market uncertainty and lower valuations. And the tech frenzy is cooling. The days of easy money and rapid growth may be coming to an end, forcing companies to focus on profitability and sustainable business models. Real estate in cities, particularly those that attracted significant foreign investment, is also feeling the pressure, like New York and San Francisco, which have seen some of the most dramatic price increases in recent years, saw huge Chinese investment driving up demand and pushing prices to record highs, pushing prices up, creating a highly competitive market for both buyers and renters. With that money receding, the real estate market is facing a potential slowdown. Expect fewer bidding wars and a more balanced market, giving buyers more negotiating power, and a possible market correction, which could lead to a decline in property values. If you banked on your home value always rising, it's time to reassess your financial strategy. This is a wake-up call. It's crucial to understand the risks involved in relying solely on real estate appreciation for wealth building. Other areas of the economy are also feeling the impact of these shifts, like infrastructure projects, universities that rely on international students, and even Hollywood, which has increasingly relied on Chinese investment for film production and distribution, are feeling the pinch as funding sources dry up and projects face delays or cancellations. Chinese investment was a network of rivers, flowing into various sectors of the global economy. Now many are running dry, leaving a void that needs to be filled. The ripple effects are widespread, impacting businesses, consumers, and investors alike. This is a multi-pronged impact, affecting various sectors and industries in complex ways. We're only beginning to see the full extent of these changes and their long-term consequences. The landscape is changing fast, requiring constant vigilance and adaptability. Stay alert, stay informed, and be prepared to adjust your strategies as the situation evolves. Wall Street's melting down, but what about Main Street? If you have a 401k or stocks, expect turbulence, especially if you're invested in companies tied to China. Job security could be at risk in industries that counted on Chinese investment, think manufacturing, tech startups, or real estate. It's not a nationwide crisis, but some communities will feel it more. Borrowing costs could rise if global markets get jittery and capital becomes scarcer. Higher interest rates for mortgages, car loans, and credit cards could follow. For investors, don't panic, reassess your portfolio. Are you overexposed to China-dependent sectors? Diversify. Look for companies with strong domestic demand. The easy money days are over, your strategy needs to adapt. Be smart, not scared. What are the experts saying? Shock, urgent notes, and revised forecasts. Major banks warn less Chinese money means tighter liquidity and headwinds for some sectors. Economists see this as a strategic shift. China is focusing on its own economy and innovation. Geopolitical tensions are forcing China's hand, and the old days of unchecked investment may not return soon. Some analysts say China will still invest strategically in key areas, and other countries might fill some gaps. Others argue this correction could force U.S. companies to focus on sustainable growth. But remember, experts can be wrong. No one has a perfect crystal ball. China's shift has unpredictable consequences. Stay informed and think for yourself. Wall Street, the Chinese money train has slowed. What's the plan? Diversify sources of capital. Look to India, Southeast Asia, Europe. Get real about valuations. No more fantasy pricing. Innovate new ways to fund businesses, focusing more on domestic investors. Adapt to the new landscape. Don't just wish for the old one. Double down on transparency and risk management. Better risk models and stress testing are essential. Get to work, Wall Street. Why does China's investment shift matter to everyone? Because we're all connected. When China changes course, the global economic ecosystem feels it. Developing nations relied on Chinese investment for infrastructure. Now they may struggle. Who fills the gap? Will Western nations step up? Global innovation could slow, and competition in tech will intensify. China's inward focus changes its global posture, affecting everything from climate talks to security. Other nations must adapt their strategies. Whether you're an investor, business owner, or policymaker, China's money matters. It shapes our world today and for years to come. Pay attention. Sell. Buy. Hold. China's pulling back. Wall Street's jittery. What should you do? Don't panic. Panic selling is a mistake. Be smarter than the noise. Look for opportunities in chaos. If you're invested in companies overly dependent on Chinese capital, consider trimming those positions. But don't sell everything with China in the name. Look for American companies with strong domestic demand and solid fundamentals. Buy quality, buy resilience. Hold companies that are fundamentally sound but temporarily hit by sentiment. Let fund managers adjust for you in diversified ETFs or mutual funds. Reassess, don't abandon ship. The game is changing. Focus on fundamentals and geopolitical risks. It's not the end of the world, but it is the end of an era. Booyah! There's always a bull market somewhere, even when the dragon changes its game.